The yield curve is a living surface. It charts the global market's collective consensus on the exact future cost of money. This diagram builds the baseline spot rate curve. It plots current yields across specific time horizons and maturity dates. A spot rate for any given maturity is actually a geometric average of the current one-period spot rate and a series of implied one-period forward rates. When the spot curve is perfectly flat, the math dictates that implied forward rates will equal current spot rates exactly, and the lines merge into a single path. But when the spot curve slopes upward, the implied one-period forward rates must be pushed mathematically above the spot curve to maintain that geometric average. Conversely, on a downward-sloping inverted spot curve, the forward rates are forced below the spot line. Every shape this curve takes maps exactly where market participants expect future interest rates to land. The unbiased expectations theory assumes that this forward rate is a flawless, completely unbiased predictor of actual future spot rates. If that theory held perfectly true in reality, bonds across all maturities would ultimately realize a return exactly equal to the one-period spot rate. Active bond portfolio management exists entirely because institutional managers believe the current forward curve is mathematically flawed. Managers attempt to generate yield by formulating proprietary predictions about how actual spot rates will evolve, and contrasting those with the forward curve's built-in suggestions. If a manager projects future spot rates will be lower than the forward curve implies, they buy bonds aggressively today. They're taking advantage of a market that is discounting future cash flows at an incorrectly high rate. Knowing that the curve is flawed is the theory. Extracting yield from those flaws requires specific physical execution. This models rolling down the yield curve. A manager holds long maturity bonds relative to their horizon. As time passes, maturity decreases. On an upward-sloping curve, yield drops. Because price and yield move inversely, this forces the market price to increase. This strategy relies on the liquidity preference theory. Investors demand a structural liquidity premium that scales up proportionally with a bond's maturity. A related concept, the preferred habitat theory, notes that market participants cluster at specific maturity lengths and will only deviate from them if compensated with adequate yield. An upward-sloping curve is an active, mandatory compensation structure that pays investors for absorbing duration and liquidity risk over longer horizons. Benchmark government yield curves are entirely free of commercial credit risk, which makes them insufficient for pricing complex, real-world institutional assets. This is the swap rate curve, built from commercial interest rate swaps. Banks prefer these unregulated curves to value assets. The physical distance to the government curve is the swap spread, measuring the exact additional interest rate assumed over a comparable government bond. To account for individual bond pricing, managers calculate the Z-spread. This constant zero volatility premium is added to every spot rate to force a bond's calculated present value to match its current market price. At a macroeconomic level, traders monitor the TED spread to gauge economy-wide credit risk, and the MRROIS spread to isolate the precise health and liquidity of the banking system itself. By measuring these specific risk spreads, managers can surgically decompose a bond's yield into distinct tradable layers of risk. Abstract rate theories only matter if they can be translated into precise dollar value market prices. This requires an arbitrage-free valuation framework. Option-free bonds use a standard spot curve, but bonds with embedded options require modeling forward rate variability using a binomial interest rate tree. It is calibrated so adjacent forward rates sit exactly 2 standard deviations apart, based on market volatility. Pricing the bond requires backward induction. Valuation starts from the final maturity nodes and systematically discounts cash flows backward. Values from multiple paths are averaged and discounted at each step to determine the current arbitrage-free market price today. However, if a security has highly path-dependent cash flows, like a mortgage-backed security where homeowners can prepay, this backward induction tree fails. Managers must use Monte Carlo forward rate simulations instead. These arbitrage-free trees and simulations transform forward rate theories into precise, executable pricing models for institutional trading desks. The math of bond pricing is ultimately governed by massive, slow-moving macroeconomic forces that physically bend and shift the term structure over time. Central bank monetary policy drives roughly 2/3 of the yield variation at the short and intermediate segments of the curve. At the long end of the curve, long-term inflation expectations dictate 2/3 of the yield variation. This graphic models a bearish flattening. Central banks hike short-term rates to combat rising inflation, violently narrowing the spread between short and long rates. During recessions, central banks cut short-term rates to stimulate economic growth. This causes a bullish steepening, dramatically widening the spread between the short and long ends. If market panic triggers a flight to safety, capital heavily rotates into long-term bonds. This creates a bullish flattening, crushing long-end yields and flattening the line downward from the right side. The changing shape of the yield curve is a real-time, high-stakes tug-of-war between central bank mandates and global inflation fears. Institutional fixed income managers physically architect their portfolios to extract profit from these specific, anticipated macro curve shifts. The baseline rule of duration is strict. Managers explicitly lower their portfolio duration when they expect interest rates to rise, and extend duration when they expect rates to fall. This chart visualizes a bullet portfolio. Here, a manager concentrates their bond holdings entirely within a single specific maturity node. Alternatively, a barbell portfolio splits allocations between very short and very long maturities, entirely avoiding the intermediate nodes. If a manager predicts a bullish flattening, where long-term rates fall, they will strategically rotate out of a bullet and into a barbell to maximize their price appreciation on the long end. To execute these complex structural rotations, managers rely on key rate duration. This measures price sensitivity at specific targeted curve nodes, rather than measuring overall parallel shifts across the entire curve. Sophisticated traders design these structural shifts to be duration neutral. They neutralize their overall interest rate risk, ensuring that only changes in the curve's specific curvature generate alpha. Mastering fixed income is a process of anticipating structural shifts in the global economy, mathematically architecting a portfolio to extract yield from that macroeconomic future.